Investment styles are systematic ways of investing that are consistent and methodical. They use a set of criteria or a theme to help them make investment selections. Investing methods might help you be more methodical and disciplined in your investing. They also allow you to track and compare the performance of your investments. Setting investment goals, let alone knowing if you're meeting them, is exceedingly difficult without a strategy. Before we go through the most common investment methods, it's important to go over some general investing fundamentals. To begin with, you should never hurry into an investment, even if you're afraid of losing money. Making hasty investments almost always backfires. Smart investments are rarely those that everyone rushes into or discusses. Second, stay with what you're comfortable with. If you don't comprehend an investment plan, you should either avoid it or educate yourself on it. Investing in stocks is the same way. Avoid companies whose business model you don't grasp. 1. Buy and hold investment. Buying and holding is the most basic long-term investment strategy. Individual stocks are simply purchased and held for an unlimited period of time. Obviously, the performance of a buy and hold portfolio is determined by the companies held. Despite being the most basic of investment strategies, buy and hold can be more effective than one might think. Investors are frequently their own worst enemies, selling investments at inopportune times. However, this method eliminates the problem. A buy and hold portfolio can be drastically improved in two ways. To begin with, look for stocks that will last a long time. A good option is to buy stocks with a strong brand that are unlikely to be disrupted. Second, maintain a small number of positions. That way, any bad picks won't hurt your portfolio too much, and the stocks that perform well in your portfolio will grow into significant positions. 2. Growth investment. Growth investment strategies have the biggest advantage of exposing you to the fastest growing sectors and industries. This means you're putting your money into businesses that have the best chance of generating high annual returns. Growth stock investing is also exciting because you get to learn about companies that are innovating and shaping the future. Growth investing, on the other hand, should be approached with caution. The market's highest valuations are usually found in growth stocks. To justify their valuations, they must live up to market expectations, or the stock price will correct, often dramatically. If you're looking to invest in growth stocks, you should do your research and avoid chasing companies solely on the basis of sentiment. 3. Momentum investment. Momentum investing is similar to growth investing, but instead of looking at earnings or revenue growth, it focuses on the stock price's momentum. According to statistics, the best performing stocks in a given period have a high chance of outperforming in subsequent periods. Price action alone is thus used to make buying and selling decisions, though it does help to avoid small and illiquid companies. A simple momentum strategy would invest in 10 to 20 of the best performing stocks and keep them for a year. All stocks are sold at this point, and the process is repeated. On a monthly or quarterly basis, more complex variations of this strategy will continuously rotate capital into the stock, with the highest momentum. Most of the time, momentum investing produces positive results, but it can also result in significant losses. Other methods should be used in conjunction with momentum investment strategies. 4. Value investment. Over the last century, value investing has produced the most consistent long-term returns. Warren Buffett made his fortune by investing in companies that produced consistent earnings at reasonable prices. Stocks that are trading at or below their intrinsic or fair value are bought by value investors. This gives you a buffer in case something unexpected happens. The lower the stock's valuation when purchased, the less the company must earn in the future to generate a decent return. To identify a company's genuine value, value investors must grasp financial statements. The majority of low-cost equities are low-cost for a reason. The aim of a value investor is to find high-quality, low-cost stocks. 5. Investing in small-cap stocks. Concentrating on smaller businesses has two advantages. For starters, it is easier for a small business to expand its earnings. It's a lot easier to double income from a base level of $100 million than it is from a base level of $10 billion. Second, smaller companies are more likely to be neglected by investors, resulting in a reduction in their stock price. Other investors will take note as the company grows, and the discount will narrow. If you are an early investor, this can reward you with a higher return. Investing in small-cap stocks has a few drawbacks. Information is more difficult to get by, and you will have to devote more time to research. Small businesses are also less liquid, with more fluctuating stock values. You must carefully manage risk and avoid circumstances where liquidity runs out before you can quit. 6. Dividend investment. Dividend investment, also known as income investing or yield investing, aims to provide a steady source of income. Stocks with high dividend yields are normally profitable, but their growth rates are slow. Your duty as a dividend investor is to select firms with a high yield that will be able to keep paying dividends in the future. It'll be even better if the corporation can boost its dividend yield. Dividend investment methods are more than just about making money. A yield portfolio can see significant capital growth if dividends are reinvested. Dividend-paying companies are often profitable, making them defensive during downturns. 7. Environmental, social, and governance (ESG) investing. ESG investment evaluates how environmental, social, and governance factors affect a company's long-term value. Companies that take governance and the environment seriously are more likely to prosper according to the logic. SRI, socially responsible investing, impact investing, and ethical investment methods are all examples of ESG investing. These measures, on the other hand, aim to limit how capital is employed. ESG investment examines the impact of similar issues on returns. Individual investors can buy ESG funds or use ESG grading services to pick stocks. The discipline is still in its early stages, and the efficacy of these tactics has yet to be established. Prior to investing in a fund or subscribing to a rating service, it's a good idea to conduct some research. 8. Factor investment. Factor investing is a method of stock selection based on evidence. Stock features that have been shown to outperform over lengthy periods of time are referred to as investment factors. Value, growth, market value, and momentum are just a few of the most widely employed characteristics. Volatility and quality are two more prominent factors mentioned. These ideas are reduced to quantifiable criteria in factor investing. A number of quantitative investment businesses have introduced ETFs, exchange-traded funds, that index stocks using factors. Advisors and even individual investors can build portfolios based on empirical facts, rather than theory, using these items. 9. Passive investing. Indexing, often known as passive investing, is a type of buy and hold investing. Individual equities are avoided in favor of indices. This method has a number of advantages. To begin with, investing in market cap weight indexes implies you'll be putting your money into the fastest growing large cap businesses in the stock market. This eliminates the need to pick stocks and guarantees that you'll own all the important ones. ETFs, which have relatively minimal costs compared to other products, are the most frequent way to go with passive investing. You can hold dozens if not hundreds of stocks by paying a single transaction commission. Most actively managed mutual funds, according to research, do not outperform their benchmark. You can track the benchmark while also saving money by investing in passive ETFs. Just like compound interest, the money saved on fees grows over time. This aspect alone can lead to far better long-term returns. Passive investment strategies, like the buy and hold approach, keep investors from destroying their returns by selling at the wrong time. 10. Core satellite approach. The passive and active investing strategies are combined in the core satellite strategy of investing. A basic portfolio of ETFs is held, as well as a few actively managed equities. This allows a fund manager or investor to profit from rare chances that index funds would overlook. When valuations are excessive, for example, individual stocks can be acquired or sold, and exceptional smaller companies can be invested in. Passive funds account for roughly 70% of core satellite portfolio allocations, with active strategies accounting for the remaining 30%. Any of the methodologies stated earlier can be used to allocate the fund's active part. 11. Long-short sale investing. Short selling is one of the few opportunities to profit from the market's downturn. This isn't just for profiting from a stock market meltdown. Combining long and short bets in a portfolio lowers market risk. The relative performance of two instruments can provide profits regardless of which way they are traveling. To accomplish so, market-neutral hedge funds employ long and short strategies. They produce return with little market correlation and can be utilized to lower the volatility of a larger portfolio. Investments by Liner, the data intelligence fund, employs market-based long and short investment strategies. Hundreds of sources are used to compile user-generated data. Artificial intelligence then utilized to gauge the market mood and identify potentially profitable patterns. 12. Multi-asset investment. In the long run, stocks usually produce the best results. They are nonetheless the riskiest asset class. Combining multiple asset types can produce superior risk-adjusted returns. The lower the volatility and portfolio risk, the more asset types are included in an investment portfolio. Stocks, bonds, cash, commodities, real estate, hedge funds, and private equity funds are all possible components of a well-diversified portfolio. Diversification can be further enhanced by distributing the stock portfolio among various of the earlier mentioned investing strategies. What factors should you consider while deciding on a personal investment strategy? When deciding on the ideal investing strategy for you, there are various factors to consider. To begin with, the strategy should pique your curiosity. If you find a method appealing, you're more likely to learn about it and conduct the necessary investigation. Second, in some cases, your own abilities and expertise can give you an advantage. Financial statements, for example, are important to value investors. It can also help if you have experience with specific sectors. If you know how to code, you could be drawn to momentum investing and want to create your own algorithm. Another thing to think about is how much time you have to invest. To do the essential research for value, growth, and small cap investing, it takes a long time. Momentum and passive investing, on the other hand, only take a short amount of time. Finally, you should think about your risk appetite. This has to do with both your finances and your personality. Passive investing or a portfolio with a broad asset allocation will be more appropriate if a volatile investment is keeping you awake at night. You have a size and flexibility advantage as an investor. You can leverage this advantage by combining one or more of these investing approaches to create your own unique strategy. Well, folks, thank you so much for watching. Have a great day, and I'll see you in the next one.